More Business Briefing right now on FM News 101.
And moving past the bottom of the hour, we welcome you back to the voice of the private sector as we count down to the Christmas holiday and turn the calendar on a new year. Glad you could join us wherever you may be. We come to you this weekend from our studios in downtown Seattle at Talk Radio 570 KVI, just across the street from the Space Needle. Also broadcasting live and local on Alpha Media's FM News 101 across Portland and Vancouver. And we have some great news. Business owners, executives, CFOs, and decision makers out there. The IRS has gotten a little friendlier, it sounds like. We'll talk about that in a little bit. But first, Congress extending some key tax issues for business owners and executives across the region. I was in Portland on Tuesday and sat down with Michael Lortz, one of the shareholders and partners at the top accounting firm in the region, Geffen, to get an update on what we can expect.
So what's on the table is the renewal of a lot of tax breaks, both deductions and credits, some of them for businesses, some of them for individuals. There's over 50 of them that expired at the end of 2014, and quite a few of these provisions are very significant to business owners in particular.
Specifically, what are we talking about? Because I know our business owner audience really, it seems like every year at year end, we see the headlines, all the gobbledygook that they're considering that they may or may not do. What specifically should our audience be concerned about?
So the provisions that affect most of our clients relate to fixed assets and depreciation deductions. And some of these are a big deal, not only for small businesses, but for large ones as well. For small businesses, they tend to care about the Section 179 deduction, which allows them to just write off equipment and furniture purchases. And up through 2014, we've been able to write off $500,000 of these purchases up to that amount. And so that's exactly what's been on the table for 2015, is whether or not that deduction continues to be allowed, or does it sink back down to $25,000, which isn't a whole lot. For larger businesses, there's a 50% bonus depreciation deduction. That allows large businesses that might be buying millions of dollars of equipment to write half of it off, or more than half of it, in the very first year that they purchase it. Maybe they'll use it for 10 years, but they can deduct a massive amount immediately.
I noticed too, and I saw this I think in the Wall Street Journal, this R&D credit for business. Tell us about that.
Yeah, the research and development tax credit is one of those credits that it seems like it expires every year or every 2 years, and then it keeps getting renewed. And that's been happening now for decades. It's a credit that's supposed to be an incentive for U.S. companies to do R&D. And quite frankly, we find that a number of our clients don't take advantage of it because of some restrictions that exist around it, such as the alternative minimum tax. We are hoping that at some point in the future, Congress will broaden how that credit can be claimed so that small businesses can take better advantage of it.
That's good to hear. If you're just joining us, Michael Lortz at Geffen here on Business Briefing. And tell us about the deduction of state sales tax for individuals. How does that play in from a business standpoint?
Well, and of course, as a firm located in Portland, Oregon, that serves a lot of clients in Washington State, our Washington clients are particularly interested in this. So Oregon residents typically deduct their Oregon income taxes. Washington residents don't pay income taxes in Washington State. However, they pay sales taxes, and there's a special provision, again, that expired at the end of 2014 that allows these Washington residents to deduct their sales taxes. So it's a sort of a free deduction. I mean, they're going to buy things anyways. They're going to pay the tax anyways. So a deduction is just gravy.
Well, that's good to hear. Okay, some other issues that we need to discuss, in particular, accounting methods for business. What's in the works here? What could be changing?
Well, accounting methods aren't the sexiest topic in the world, but on the other hand, they can make a really big difference when evaluating taxable income. And of course, our clients want taxable income to be lower if possible. So one of the things we look at from a big picture standpoint is this concept of accrual accounting versus cash accounting. To make a long story short, some businesses have to use accrual accounting, but others qualify to use the cash method. And for our clients, we find it's very important to evaluate annually if they're on the cash method of accounting, would accrual make more sense? Would it save them money? And where we find that is for our clients that get paid in advance. Now, we'd all like to get paid in advance, right? Before we do the work. Well, some of our clients actually do. And for those clients, they don't want to have to pick that up as income until they actually perform the work later. And the accrual method actually helps them do that. And it's a little counterintuitive because most folks think the cash method is preferable, but it's not always.
That's interesting. I'm thinking about how we do business, and that may actually apply to our business, so I'll have to talk to you after the show. Capitalization threshold for fixed assets. First of all, let's talk about that because that's not something that business owners typically think about when they walk into the office every day.
Yeah, that's right. Although I think our clients have been thinking about it more often because we've been working with them on this topic quite a bit the last couple of years. So the IRS over a year ago came out and provided some regulations that said businesses that don't have audited financial statements would have a safe harbor where they could deduct fixed asset items of up to $500 without having to capitalize them and depreciate them. Well, that's great, but $500 is not that high of a threshold. The IRS just recently came out and said we're going to increase that threshold from $500 to $2,500. And frankly, as a tax professional, I was very surprised. I knew they'd been considering raising it due to comments. I thought maybe $1,000, but $2,500, what that means is a lot of our clients that, for example, buy computers that cost $2,000, they could simply write those off for tax purposes without having to depreciate them over time. And it's per item. So I might have a $10,000 invoice for 5 computers, but each one costs $2,000. I could now write off the entire $10,000. It's a significant benefit for businesses.
That is a significant benefit. And I mean, computers are the first thing that come to mind. But I mean, you look at a lot of the, fixed asset purchases we make and small businesses make as well for, whether it's bakeries or bartenders or whatever it may be across Portland or Seattle. This applies to a lot of different stuff.
That's absolutely right. Our firm, for example, is expanding. We're going to take on some new space. I'm sure we're going to have to buy some new furniture, and I'm sure a lot of those desks and chairs, etc., are going to cost less than $2,500. So it will help lots of companies, whether they're growing or simply replacing existing items.
Michael Lortz joining us here from Geffen Mesher. And one other interesting change that really will help all of our friends and clients in the restaurant industry.
Yeah, so this is particularly important for folks that own restaurants, own retail operations that from time to time will do a refresh. They're wanting to make sure that their storefronts, their restaurants look current, and those can be somewhat spendy. And for years, there's been these arguments between taxpayers and the IRS as to, can we deduct some of those costs? Do they all have to be depreciated over 39 or 15 years, which is a long time? Well, the IRS just recently has come out with a safe harbor that essentially says that taxpayers can write off 75% of those costs and then depreciate over time the other 25%. Now, the catch on this one is you have to have an audited financial statement or an equivalent. So very small businesses, this probably isn't going to help, but some of the multi-location operations, this could be very helpful. And it really points to a larger trend where the IRS is providing more and more of these safe harbors. And these safe harbors are like a compromise. The taxpayer gets some of what they want, the IRS gets some of what they want, but if the taxpayer elects to use the safe harbor, then it shouldn't be an issue in the event of an audit.
Michael, I have to tell you, as a business owner myself, it's nice to get good news here at the end of the year because it seems like year after year, we're always facing a change that could have a negative impact on our business, but we see, safe harbor, changes in the capitalization threshold. These are good things for business that actually make it easier to do business.
Yeah, that's right. And we try to make sure that our clients are very aware of these opportunities as they come up. It's important to get these changes in front of our clients so that they can take the appropriate action.
That's Michael Lortz at Geffen Mesher. Now stay with us in our next segment, some key changes and updates to retirement income planning. We'll talk to Michael about that when Business Briefing continues.
You're listening to Brian Bushlach's Business Briefing on FM News 101.
And approaching the top of the hour here on Business Briefing, news, traffic, and weather on the way, followed by hour number 2. First, though, back to our conversation with one of the top CPAs in the region, Michael Lortz at Geffen Mesher. And there's been some good news. If you missed the last segment and you're a business owner, check out our podcast because Michael detailed that. Good news from Congress and good news from the IRS. Welcome news overall. Also, some key things to consider here at year end. I know only a few days left in 2015, but there is time to implement some tax planning when it comes to retirement. And I talked to Michael Lortz about that.
Yeah, Brian, we've all heard the reports in the media about how little Americans save for retirement, about how many of them are apparently going to rely on Social Security someday. And so I think we all know that saving for retirement is very important. We try to encourage our clients to save more for retirement whenever possible. There's lots of different retirement plan options out there to help you do that. Where we can be particularly effective is showing our clients just how much money they save by making retirement plan contributions. One of my clients this year is having a fabulous year. They're a solopreneur. They're going to do over $2 million in revenue all by themselves, no employees. It's pretty remarkable in a service business. And one of the things that we came to that individual with was an idea for how to maximize retirement plan contributions. And people know about 401k plans. They might know about SEP or simple plans, but very few people realize that defined benefit plans, the sort of plans we think about for pensions and unions and giant companies, those same types of plans can also be used by very small businesses to increase retirement plan contributions. And in this particular case with this client, by using one of these defined benefit plans, as well as a 401k plan, this client's going to be able to put away around $140,000 into retirement plans. That's tax-deductible contributions to reduce that tax, which for this individual, because of what a great year he's having, his tax rates are going to be around 45 to 50%, federal and state combined. So that's real savings, and it's going to allow him to save for the future. He's only in his early 40s, so this is something that can grow and compound over time.
That's good to hear positive stories as well. We've come through that period where we're trying to figure out, small business owners, day to day, week to week, month to month, how do I get through this? Now we've gotten through that and we're starting to prosper again. And now you've got these other planning issues like, I had a great year. Now what do? I want to try and reduce that tax burden. You hear stories like this, and it's great that you've come up with this plan. This certainly wouldn't apply to a lot of individuals, but there are those folks in Portland and Seattle who would qualify for something like this.
That's absolutely right, and that's part of what planning is all about. We talk to our clients about what do they want to accomplish, what are their goals. In the case of this individual, he knows that this great year he's having this year might not repeat next year. In fact, it's somewhat unlikely. And so in his mind, this is an opportunity for him to catch up a little bit with retirement plan savings and also try to get a little bit ahead for the future years. So we were able to help put together a plan that allows him to not only increase his contributions this year, but also does not lock him into having to make those same contributions in future years when his income could be substantially lower.
That is so critical, especially for small business owners. If you're just joining us, Michael Lortz here at Geffen Mesher. Charitable giving also this time of year. It is that time of year when people are more charitable, but you have to be careful how you structure this, right?
You do. And one of the common issues we run into is clients come to us and say, I'd like to do some charitable giving because I'm having a really good year, but I'm not exactly sure who I want to give to, and time is running out, and I'm not sure I'll be able to pull all that together before the end of the year because I want to make a really good decision with who I give that money to. So one of the things we frequently talk to clients about is something called a donor-advised fund. In fact, the individual I was just talking to you about for retirement plan contributions, same fellow, we said, if you're interested in doing charitable giving, you might consider a donor-advised fund. And he said, well, I am. I don't know that I want to give all the money right now, but I know this is a great year to save up money for doing some charitable giving. So how can I get a deduction right now when I have a lot of income? A donor-advised fund essentially allows an individual to make a contribution to a fund and then subsequently, in future years perhaps, direct where that organization sends the money. So they get a deduction this year, and the monies get dispersed to charities over time in the future.
We love donor-advised funds. In fact, we're considering that ourselves, and that's a great opportunity. And I think what we like about that is exactly what you said, Michael, is you could, let's say you donate $10,000 in tax year 2015. That money sits in that account at that donor-advised fund and might be distributed over the next 2 to 3 years in increments that you determine, right?
That's absolutely right. And historically, I would say donor-advised funds were something that very wealthy people established, but not many others. That is changing a lot. There's lots of good local community foundations that administer these. And beyond that, the largest fund in the country is actually put together by Fidelity. And the minimum contribution to the Fidelity Fund to set one up is $5,000. So this is something that people can set up at various levels of wealth and income. The money can also be invested. So for example, the Fidelity one allows you to pick from a basket of investment options so that if the money is going to stay in there a while before it gets dispersed, you can actually have it grow potentially.
That's good to hear. If you're just joining us, Michael Lortz at Geffen Mesher here on Business Briefing. And Michael, I'm going to have you on our Uity Lifestyle Show on Saturdays in the Portland market and in Seattle as well, because this next topic is one that I know millions of Americans will grapple with if they're not already. We talk about retirement, income planning, 70 and a half with required minimum distribution, RMD. For short, this is an issue because people are living longer now, and now if you're required to distribute your retirement savings, that could impact millions of Americans.
That's right. So the rules say that once you reach age 70 and a half, you have to start pulling money out of your retirement plan accounts, whether you need that money or not. And that means that that money is taxable when it's distributed to you. And what we find, quite frankly, is that not everyone is aware of those rules. There's lots of folks that miss taking these distributions and then down the road have to catch up and potentially pay a penalty as a result. So we try to make sure that our clients are aware of the rules, and then we also talk to them about how best can they use those distributions. One of the things we've looked at in prior years is the opportunity to transfer some of that money directly from an IRA, for example, to a charitable organization. If our client is charitably inclined anyways, that's a more tax-efficient way of doing it than if they had simply withdrawn the money and then written a check to the charity. A direct transfer is more tax-efficient.
Last and certainly not least, gifting is always a nice way at the end of the year to help out a relative or a family member. What's the latest number on gifting, and what's your advice there?
So oftentimes I find that our clients are confused about gifting. One of the questions I get asked is, Michael, I received a gift from a family member. Is that taxable? And the answer is that the recipient of the gift never pays taxes on it, assuming that it's from somebody else in the United States. Foreign gifts are a more complicated subject. But within the United States, the receiver never pays tax. The giver might. And so the IRS has an annual amount that each person can give to other individuals. It's $14,000. It's called the annual exclusion. And it goes up from time to time, but this year it's $14,000. Now, I could give $14,000 to 10 different people and not have any gift tax concerns. Once I give more than $14,000 to somebody in a year, then I have to file a gift tax return. And I may or may not have gift tax to pay, depending on how much other gifting I've done in the past. But many of our clients take advantage of this opportunity to, on an annual basis, make these type of gifts. It's also a good estate planning technique for folks that have that wealth. That way they're able to transfer the wealth to the next generation or perhaps to grandchildren without having any sort of gift or estate tax concerns.
Always great insight from Michael Lortz at Geffen Mesher. And if you'd like to reach out to him, Michael always accessible for his clients. M. Lortz, that's MLORTZ at GMCO.com. When we come back, hour number 2 of Business Briefing after news, traffic, and weather.